Buy low, sell high. No one knows who the first person was to utter these words, which have become a long-accepted business investment mantra. That is no doubt what hip-hop clothing impresario Damon John was thinking when he accumulated his first clothing orders from a Las Vegas retail convention in 1994. He just knew he was going to make money. But investor returns don't come from profits. They come from cash flow. And companies don't go out of business because they lose money. They go out of business because they just run out of cash. Damon's company, Fubu, was on track to be profitable from the very start, but almost lost out as it nearly ran out of cash. He would have benefited from understanding the 6 drivers that combine to determine investor cash yields. Welcome back to the Value Equation channel and our unfolding of how to get business rich. I'm Chris Volk, Value Equation author and your host on this journey to understand how companies create wealth, enabling their many owners to join the ranks of the world's richest. And by now, you should know where corporate returns come from and have been introduced to the 6 high-level value equation drivers of current corporate equity cash yields. The value equation is a financial tool, which means it excludes accounting non-cash conventions together with sales and expense gross-ups. Basically where revenues and expenses get blown up because accountants put the same numbers in both places. Entrepreneurs instinctively speak a language of finance, which is a universal language. It's like music. Entrepreneurs know what things cost, whereas accounting rules permit adjusting historic costs. Entrepreneurs know what their businesses cost to operate from a cash flow standpoint, whereas accounting rules entail overlaying non-cash charges. And entrepreneurs virtually always know how much cash they have in the bank. They think in the language of the value equation. To remind you, there are 6 value equation drivers. Number 1 is sales. The second driver is business investment. The third driver is operating profit margin. The fourth is the percentage of other people's money, OPM, you use to fund your business investment. Number 5 is the cost of that OPM. And the last one, number 6, is maintenance capital expense requirements. And all these variables merit explanations. As tire innovator and pioneer Harvey Firestone once said, success is the sum of details. And being a successful business entrepreneur, leader, or investor requires attention to detail. So first off, sales. This is an easy to understand variable. It involves products or services sold for cash or contractually owed accounts receivable. Ignore accounting gross-ups where sales and expenses are both jacked up by offsetting numbers. This is infrequent, but happens, and so it overstates revenues, understates operating profit margins, and ignore any accounting conventions that gross up sales with non-cash estimates. Real estate companies like the ones I ran can see this in the form of a convention called straight-line rents. The second value equation variable is business investment. You can think of this as assets that you use at cost, minus any free money. Free money includes supplier trade payables, accrued expenses, customer deposits, gift cards, and deferred taxes. If you choose to rent certain real estate or equipment rather than own it, my personal preference is to include the cost of these assets in with the assets that you own at cost. You don't need to do this for the value equation to work, but not doing so will serve to hide a potentially material amount of assets that you use in your business. Consider the many airlines or pharmacy chains which tend to rent locations and aircraft rather than purchase them. Omitting the cost of these assets, funded by leasing companies, depresses the true cost of business investment while making it difficult to compare companies using different financing mechanisms. There's an advantage in businesses to being asset light, but renting assets does not make that happen. Outsourcing part or all your product production is the way to limit business investment. Apple is a great example, noting on its products that they are designed by Apple in California, but the products are made elsewhere, which means that Apple avoided the significant business investment associated with product manufacture. And when it comes to business investment, remember to ignore any accounted non-cash assets, such as right-to-use assets, or straight-line rents, or other manufactured accounting numbers that don't reflect real asset costs or amount that are contractually due or pledgeable as collateral against borrowings. The third variable is operating profit margin. This is the profit of the business before non-cash accounting conventions like depreciation or stock-based compensation. And it's before paying for interest expense. If you have items that you could have purchased but you chose to rent them instead, I tend to back out the related lease expenses also. That step, like including leased assets into business investment, is totally optional. But the idea of other people's money, or OPM, is that it's proceeds you realized whether you borrowed the money or you elected to have a leasing company buy the assets for you and lease them to you. Lastly, if you're an entrepreneur and starting a business, it's important that your operating profit margin include the cost of your personal salary. There's being a CEO, and then there's being a shareholder. You can be both, but the CEO compensation needs to be included in your company's cost. If there is no cash flow left after you pay your salary, then you just bought yourself a job, but you've likely created no business value. The fourth value equation driver, well, that's OPM, which includes both borrowings and lease proceeds. Again, with the value equation, you could ignore the latter, not factoring in leases, and you'll arrive at the same current investor cash flow yield. Lease proceeds appear nowhere on the financial statements, so you'll either have to know this, which you would if it's your company, or you can estimate it by seeing the rent expense within the profit and loss statement and then applying an estimated market rent factor to that number. To illustrate, let's say that you see a rent expense for real estate of $80,000 a year, and you believe that a rent factor of 8% approximates market. That would make the estimated proceeds used for real estate to be $1 million. You'd add this amount to your business investment and would also include the same $1 million in OPM. OPM is conceptually simple. It's just money you contractually owe that has an interest or lease rate cost to it. The fifth driver is the cost of OPM, which is the weighted cost of interest and leases as a percentage of outstanding average OPM proceeds. And again, if you elected not to take the step of incorporating lease proceeds into OPM, you can just use interest expenses as a percentage of average outstanding borrowings. If you're a company business leader, you're going to know this number. If you're an investor, the financial statement footnotes will generally have this information. The final value equation driver is maintenance capital expenditures, otherwise known as maintenance CapEx. This is the average amount your business spends each year on furniture, fixtures, equipment, and real estate enhancements to remain competitive and retain current revenue levels. The average is important because maintenance CapEx in some years will be far more than other years. Think about hotels, restaurants, and other consumer-facing businesses with operators who periodically spend a bunch to re-image their facilities. Consider manufacturers who periodically need to retool their production facilities or replace worn-out equipment to retain their revenue streams. But I also add other costs into this category. Consider multi-location companies that periodically shutter non-performing sites, and then they sell them for less than their original cost. Many well-known large retailers would be included in this list, including Walmart, pharmacy chains, CVS, and Walgreens, just to name a few. It is commonplace for multi-unit retailers or service companies to have non-performing locations they shutter and sell at losses. So in addition to averaging the cost of maintenance CapEx, I'd factor in the average annual expected loss on shuttered locations relative to their initial cost. And finally, for acquisitive companies that buy other companies, I factor in the average cost of losses on business closures or sales relative to their business cost. A great illustrator is Alphabet, the parent company of Google, which has purchased more than 250 companies, including YouTube, Fitbit, Waze, DoubleClick, Mandiant, Nest, and Motorola Mobility. The last of these was bought for $12.5 billion in 2011 and sold off to Lenovo for $2.9 billion just 3 years later. Or think about Verizon, which paid a combined $8.9 billion for web search engines Yahoo and AOL, and later sold both off at a nearly $4 billion loss. Such failures are similar to shuttered locations, part of corporate business model risks associated with being acquisitive. Mistakes are made, they cost money. The average amount of that cost belongs in the value equation, and the easy place to throw it in is in with maintenance CapEx. Now that we understand the 6 value equation drivers, and now that we're truly focused on the details of business models, we're ready to turn the variables into a quick equation to determine current investor corporate cash yields, which lie at the heart of corporate financial success. If you're fortunate to have stock in a company having a solid business model, you have improved odds of becoming a multimillionaire. And that's because that's how most multimillionaires and all billionaires got that way. They became business rich. So let's understand how most multimillionaires made their money. I'm Chris Volk. You can find me at ChristopherHVolk.com. And thank you so much for joining me on this business wealth creation journey.